Hello, everyone. Today we're going to talk about the progress from what happened on Friday, right? My plan with going with SoFi to what happened today. So the good news is that from the week, right? So from Friday, which was let's take a look at it, the 7th, uh, 7th, yeah. So Friday the 7th, I was roughly around like 41.9. Now I'm at around 42.8. So 900 increase. As we previously discussed, I had 130 call options or covered calls, 130 covered calls is so far. And my cost basis, I believe, was 702. I sold the calls at 17 cents a piece. So the max profit would be 15 cents, 15 cents a share or $15 per contract, which equated to roughly 2K. So technically, I would have maxed out at around 44K or like an extra 2K if SoFi had expired above $7 by the end of the date, which was this Friday. Now the thing is, one thing I learned from just kind of this is just my own personal journey. One thing that I kind of learned is that if you do secure within a very short time a significant part of the contract value or the contract premium, what you would have collected, then in my experience, I like to just exit out of the position right away. So say, for example, a rule of thumb I have is like if I get more than 30% in about a very short time frame of the contract, let's say it's only a week, and in one day from Friday to Monday in this case, I get about anywhere like let's call it like half the contract value or 30%, 40%, then I'm exiting out. And it's really simple. It's just that stocks tend to fluctuate. So for example, SoFi could go up to the $7 as it stands, and then it could go back down to 690, 680. I want to be able to capture those swings, get the profit, and then if it dips back down to like a lower price, I enter back in. So it's just as simple as that. But what actually happened this morning? What actually happened this morning was I actually performed a lot of trades, several trades today. Not a lot of trades, but several trades. So I'll try to explain this as briefly as I can. So initially, SoFi was down to like $6.90. And once again, my cost basis was 702. So technically, I was down about 12 cents, roughly. And the contract that I had, remember, when you sell a call, it's a call. So what happens is its value increases as the price of the stock increases, and its value decreases as the price of the stock decreases. So because the price of the stock went down about 12 cents, the contract went from 17 cents to 11 cents. So I was able to make about 6 cents increase. But remember, I lost about 12 cents in terms of my value, and I ended up selling out at a loss. Now, why would I do that? The reason I would do that is because I ended up purchasing Riot this morning. Riot's a Bitcoin miner. I really do like their valuation. They're doing pretty well as a stock miner. Initially, I was in CleanSpark, and that was my favorite position. Except now it's pretty fairly valued, CleanSpark, whereas Riot's not as fairly valued. So I tend to favor it more at the moment. But what happened this morning was it dipped down pretty low, more so than what SoFi did. Because SoFi only went down about 10 cents out of the $7, which is a much smaller fraction than Riot going down from like 980 down to about 950. Right. So in that case, I saw a bigger fluctuation down here, which means that there's a possibility for a bigger fluctuation for it to go back up. Because without going into too many particulars, the book value of Riot, I think, is somewhere around $8 to $9. So it's very fair. It's at a very good price, in my opinion, if I were to buy it at $8 or $9. So anywhere, looking at it right now, even as it's approaching 950, I'm looking at possibly exiting my position and getting into there, doing some quick trades on it, getting some money from it. So what happened this morning? If we take a look at it, let's see if I can show my trades. There we are. So what happened was the following. I went ahead and purchased this morning 6,000 shares, right, at 979, or sorry, 6,000 shares at 949. There we go. When it dipped below, I purchased 6,000 at 949, and then I sold contracts at it at 9.50. So I would only appreciate 1 cent, right? So I'm not looking for the stock appreciation. I'm just looking to capture this 39 cents. And so I went ahead and held it. Then within less than an hour or so, I think it was like an hour, maybe 2 hours. So I just kind of watch it in the background. I set alarms just to see if it'll go up. And once again, it had a little bit of a fluctuation. I was able to sell it at a loss. So if you see 39 cents to 50 cents, that's an 11-cent loss. But I ended up selling the stock at 72 cents. So if we do the math there, 72 minus 49, what is that, 23 cents? And then in this case, 23 cents minus this 11 cents, that's 12 cents. So 12 cents or $12 per contract. And I had 60 contracts. So that ends up being roughly $700. So I made a profit on this deal this morning from Riot, $700. And like I said earlier this morning, I lost a little bit on SoFi. I exited out at a loss so I could essentially gain here. And overall, it netted me about, I think it was around $300. And then, and then I ended up getting into actually McDonald's for 300 shares. So technically, I got into McDonald's twice. Once I got into McDonald's, and I only made like $100 on. Essentially, what happened was it was at. You can take a look at the prices themselves. All right. So we take a look at the trades. We'll go more. Okay. So we can see here. Where was it? Here it is. So I bought 300 shares at $254.49. And then I sold calls out of the money calls at $255 for $600. So essentially I could reduce my cost basis by $2 if it's lower, or if I could just make $600. What happened was it ended up going up about how much? So 254.50 to 255.10, let's call it, so 60 cents. It went up about 60 cents per share. So what's that, like $180. But then I was able to sell the contract at 233 instead of the 201. So essentially I made only like, let's say like $80 or so. So this was another contract I made. Right now, currently I'm in McDonald's, and that's because it went back down, and I bought it at a lower price, 253.67, and then I sold some in the money calls. So I sold covered calls, but they were in the money, so they're safer. So it's not actually $846 I would make. It's actually 253.67 minus the strike price of 252.5, and then you would take that away from the premium. And so roughly it ends up being about $160 per contract, or $500 overall. So I could make $500 as long as McDonald's is above 252.50 by Friday, because this is still expiring this Friday. And I did it because McDonald's tends to not move around a lot. It tends to be like, I think it's like a fairly safe price. And so I'm putting my money in things that are like, I try to have them in undervalued companies, so that way I'm not that much at a risk of a loss. It's worse when you put your money in a company that's fairly valued or overvalued, and you expect it to go up, and it gets cut in half or gets cut by a third, and you can lose a lot of money there. So I always try to go for undervalued companies in that sense. Undervalued and semi-solid ideally. I would like to have those two. Now, the other way I made my trade, because you could say, well, you made 300 earlier, you made 100, but overall you netted like about supposedly 1,000, right? Let's call it $900. How is that? Where's the other 600 coming from? Well, it's once again, I believe it was from Riot again. So I got into Riot one last time. So the first time I made 300 on it. The second time, let me double check if it was through Riot, because like I said, there were several trades I made. The first one was exiting SoFi, getting into Riot, and then getting. Oh no, it was from SoFi. Sorry. So just to keep it straight track of it, it was going from SoFi initially at a loss to Riot for a profit of about 200, and then afterwards it was McDonald's, and that was about $100, and then it was the SoFi, and there I made roughly, I think it was the $600, and then afterwards it was the back to McDonald's. So that was kind of the sequence. I probably should have listed this from the beginning, but that's okay. So let's look at SoFi, how I played that. So if we take a look back at the tradings from today, we can see that I did end up selling at the loss. We can see here, I ended up selling right at 690. So that's definitely at a loss from my 702. But I also, it's because I was able to buy my contracts back at a cheaper price. I don't know if the contracts are reflected here. I believe they should be, but it just looks like it's just shares, but that's okay. So, just have to take my word for it that the contracts, as the value went down, the contract price went down. So I was able to buy it back cheaper. But obviously I sold it at a loss here. Anyways, so then what did I do? I went ahead and I bought many shares at 690. What did I buy it at? 690. Yep. I bought here. This is the buy at 690. Here's the 2,000 shares. So it was roughly, yeah. So it was these two. It was around 13,000 shares again. So I reclaimed my position, and it was at 690. And then I ended up selling it for $7. So you might think that was a 10 cents gain, or 10 cents gain for the 13K shares, so 1,300. But it wasn't pure just 1,300. I also, as always, sold contracts on it. So as the price went up, the contract also went up. So it cost me a little bit more to exit out. And so roughly, so even though the stock appreciated, I lost some of the money by buying back the contract at a more expensive price, but it ended up being a net gain. And so this is just one way I choose to play it. As you see, as it fluctuates down, I go ahead and enter the positions as it kind of increases, and I get to capture a percentage of the gains. In that case, the 600 gain out of the 2,000, roughly a third in like a few hours. I think that's well worth it. Right? But I didn't have to do anything, right? It's just all passive for the most part, except for kind of occasionally looking at my phone. So that's just kind of the strategy there. And then I go back into I try to go back into safe position, so that if there ever is a correction, I can then allocate my money towards those better opportunities. That said, I'm currently in McDonald's. McDonald's looks like, you might be asking, why am I in McDonald's? It's because generally speaking, it's pretty stable company. If we take a look at some of its values, we can see that in the past, let's do 5 years. One, this is the stock price. This isn't a reflection of the market cap. We could take a look at the market cap, but the market cap is like, it looks similar, very similar to this. So there's cases where it's gone up, it's had a drop, gone up, had a drop. I'm like, okay, that's one nice thing when you buy a company at a drop, but you also have to see, is it doing well financially? Is it doing well in terms of its fundamentals? You can see here its EPS. CPS is pretty solid. It hasn't really dipped down. It had a dip down in Q4 and Q1, so that's probably why it's being penalized a little bit. Its fair value is still around 300, but it's being priced at 253. It does have a dividend, so the dividend is about 3%. The only reason I mentioned the dividend, or 2.5%, the only reason I mentioned about it is because I don't really play dividends. To me, that's not my strategy. But generally, when you have a dividend, it's got an ex-dividend date when it gets recorded, and then it'll get decided who gets paid out because they own it at that point in time. Let's say they paid, they'll pay it every quarter typically. So let's say 2.5% of 250. Let's call it 2%, so $4, and then let's call it $5. $6. Let's call it $6. So they would pay a total of about $6 divided by 4, $1.50. So when they pay that $1.50 out, technically the stock price should only go down by $1.50. But a lot of times it'll have like an exaggerated reflection on the stock price, so it'll get paid out. So it'll go up before the ex-dividend date, and then it'll crash by typically after the ex-dividend date, more so. And then a good way is if it was fairly valued before, you would just buy it on that dip, and then you can sell it when it comes back a little bit. So that's one way to play the dividends. In my own personal opinion, that's something I could do, but this is just to say, this is why I think it's down. And also, like I said, it's getting penalized because it had some quarters that were kind of lower than expected, but still solid quarters. So hopefully that makes sense. I appreciate you for watching. Thank you so much. I'm going to go ahead and share some more of my journey as I move along. Typically, if there's any exciting moves, I'll go ahead and share that. Maybe not every day, but as long as there's exciting moves to share, or even losses. So I don't mind someone sharing losses or gains. I just kind of want to be transparent about how it's been going, and then this way it kind of gives ideas to others, maybe, or not ideas to others, but just kind of entertainment to others, and maybe kind of interest them in the idea of investing. But that said, once again, not a financial advice. I'm not a financial advisor. I have no background in it in any formal sense. I just like to self-study it. So thank you so much again. I hope you have a wonderful day, and I'll be seeing you soon.